Hey everyone! Look, have you ever stared down the massive, labyrinth-like US tax code and just felt completely overwhelmed? If so, you are definitely not alone. But today, our explainer is going to completely demystify this entire system for you. We're going to break down the real-world complexities of individual deductions and show you exactly how the math actually works. And to do this, we're going to follow the financial lives of two really interesting people. Courtney, a 40-year-old self-employed architect who is navigating a pretty complex financial year, and her retired mother, Gram. Okay, let's dive right in.
So are you paying more taxes than you legally have to? Honestly, it's the ultimate question we all ask ourselves every single year. To answer it, you kind of have to shift your perspective. Think of the tax code as a massive top-down mathematical funnel. You pour all of your gross income in at the very top. But what eventually trickles out at the bottom, your actual taxable income, can be shrunk down significantly if you know exactly how to use the filters inside that funnel. Basically, every single deduction is a filter that catches some of your money and protects it from taxation.
Part 1. The tax deduction funnel. As we descend down this funnel today, Courtney and Gram are going to be our guides. Now, Courtney has a very busy financial life. She's got a primary job, a side hustle consulting business, a rental property, and she recently moved to Kansas City. Gram, on the other hand, lives with Courtney, is retired, and has a much simpler, more streamlined financial setup. By watching how their very different incomes and expenses filter down through this tax funnel, you'll see exactly how the rules apply to entirely different phases of life. As we pour their income into the top of the funnel, we hit our very first and arguably most critical checkpoint, adjusted gross income, or AGI. AGI is calculated simply by taking your gross income and subtracting what are known as 4 AGI deductions. The absolutely crucial point to remember here is that AGI is the mathematical fulcrum of your entire tax equation. The number you end up with here dictates exactly what you are allowed to do further down the funnel. A high AGI might totally disqualify you from certain tax benefits later on, while a lower AGI might open up a ton of new opportunities.
Part 2. Deductions for AGI, the VIP pass.
Because they happen before we even calculate AGI, these for AGI deductions are what I like to call the ultimate VIP pass of the tax world. Why? Because they reduce your taxable income dollar for dollar. There are no complicated thresholds you have to cross first, and they never get blocked by standard deductions. If you have a legitimate for AGI deduction, it instantly shrinks the amount of income the government even looks at. Now, Congress generally decides who gets this VIP pass based on the difference between business activities and investment activities. If you're highly involved and putting real effort into generating a profit, like a full-time job or a self-employed side hustle, you're engaged in a business activity. Congress rewards this by allowing you to deduct ordinary and necessary business expenses right at the top. But if you just buy a plot of land hoping it appreciates with very low involvement, well, that's an investment activity. And aside from rental and royalty expenses, those costs generally do not get that VIP deduction pass.
On your actual tax return, this all happens on Form 1040 Schedule C. Remember Courtney's architectural consulting side hustle? Well, this year she brought in $19,500 from it. But she also spent $1,500 on legitimate direct business expenses, mostly travel. She doesn't just eat that cost. No way. She puts that $1,500 right here on Schedule C. It acts as a VIP 4 AGI deduction, instantly dropping her net consulting income to $18,000 before the IRS even calculates her AGI.
But here's the cool part. You don't actually have to be a business owner to get a VIP pass. Congress also uses these 4 AGI deductions to subsidize specific behaviors they want to encourage, or sometimes just to fix inequities. For example, to encourage education, Courtney's brother Jason is able to deduct up to $2,500 in student loan interest as a 4 AGI deduction. Or take Gram. She had to cash in a certificate of deposit early and got hit with a $410 early withdrawal penalty by her bank. Congress allows Gram to deduct that $410 4 AGI, so she isn't unfairly taxed on interest income. She literally had to forfeit back to the bank.
Part 3. Itemizing your deductions, the receipts.
Okay, once we subtract all those VIP passes, we officially arrive at our AGI. But the funnel isn't done with us yet. Now we move into the from AGI deductions. This is where things get really granular. You essentially have two choices here, and the first path is the grueling but often highly rewarding path of itemizing your deductions. This is the path of keeping every single receipt, tracking your life's expenses, and basically proving to the government that your overall ability to pay taxes has been reduced. So if you take this itemized path, what exactly are you tracking? The major eligible categories include medical expenses, state and local taxes, mortgage interest on your home, and charitable contributions. Because Courtney has a very complex financial life, she owns a home, pays high state taxes, and donates to charity, this is the path she's definitely going to take.
But listen, itemizing comes with some incredibly harsh realities, specifically when it comes to medical expenses.
Back in April, Courtney actually broke her wrist in a mountain biking accident. Between the emergency room, the prescriptions, and all that physical therapy, she was out of pocket $2,400 after insurance. You'd think she could just deduct that, right? Actually, no. The tax code imposes a strict floor limitation on medical expenses, set at 7.5% of your AGI. Because Courtney's AGI is a very healthy $207,000, 7.5% of that is $15,525. That means Courtney literally has to spend over $15,000 out of her own pocket before she can deduct a single penny of medical expenses. So that $2,400 broken wrist yields absolutely zero tax benefit.
Now, all of this receipt keeping builds into Schedule A, which is the official home for itemized deductions. And even without her medical expenses, Courtney's diligence pays off massively here. She maxes out her state and local tax deduction at the $10,000 cap, she deducts over $14,000 in mortgage interest, and she made a totally brilliant move by donating appreciated stock worth $10,600 directly to her church. By doing it this way, she gets the full fair market value deduction and entirely avoids paying capital gains tax on the stock's appreciation. Pretty smart, right? Add it all up, and Courtney's itemized deductions total a massive $37,378.
Part 4. The standard deduction, the easy button.
But what if you don't own a home? Or what if you don't have $10,000 in local taxes? Well, Congress created an alternative path down the funnel, the standard deduction. Think of this as the easy button. It is a flat, completely automatic amount that you can choose to deduct instead of itemizing. It provides a baseline of untaxed income for everyone, and honestly, it saves the IRS from having to audit millions of shoeboxes full of crinkled receipts. The rule is super simple. You take whichever is higher, your itemized total or your standard deduction. For Courtney, filing as head of household, her standard deduction would be $21,900. Since her itemized receipts total over $37,000, she happily itemizes. Gram, however, files as a single taxpayer over the age of 65, giving her a standard deduction of $16,550. Gram only has about $11,500 in itemized receipts, so Gram takes the easy button. But notice, this creates a real double-edged sword. The easy button automatically erases the tax benefit of any itemized deductions you have up to that standard amount. The first $16,550 of Courtney's itemized receipts essentially give her no extra advantage over someone who just simply took the standard deduction.
So if you're like Gram and your itemized deductions always seem to fall just short of the easy button, I want to share a brilliant insider strategy with you called bunching. See, Gram usually donates $7,500 a year to her church, but because she takes the standard deduction, she gets zero extra tax benefit for that generosity. The bunching strategy fixes this completely. Gram can shift 2 years' worth of donations, $15,000, into a single calendar year. By lumping her expenses together, her itemized deductions suddenly spike to $19,000, easily beating her standard deduction threshold. She gets a much bigger tax break in year 1, and then in year 2, she simply presses the easy button and takes the standard deduction again. It's a completely legal, highly effective way to maximize the funnel.
Part 5. Qualified Business Income, the finale.
Okay, we've made it to the very bottom of the tax funnel. We've subtracted our 4 AGI VIP passes, we've taken our itemized or standard deductions, but right before we arrive at our final taxable income, there is one last incredibly powerful from AGI deduction available for business owners, the deduction for qualified business income. This is essentially a 20% bonus deduction on income generated from a qualified trade or business, like a sole proprietorship, partnership, or S-corporation. Courtney's architectural consulting side hustle qualifies for this perfectly. After a few specific calculations, she gets to instantly shave thousands of dollars off her taxable income entirely tax-free just for being a business owner. But you have to be careful. Congress puts strict limitations on this one. If you are in what they call a specified service trade, like health, law, accounting, or investment advising, and your overall income is too high, this 20% bonus deduction phases out and can disappear entirely. Fortunately for Courtney, architecture is specifically excluded from those phase-out rules.
And that brings us to the very bottom of the funnel. We've taken gross income, applied those VIP for AGI deductions, navigated the tough choice between grueling itemized receipts and the standard deduction easy button, and applied the final business income bonuses. Which leaves me with a final thought for you to consider as you look at your own finances this year. Are you just automatically hitting the easy button when you could actually be bunching your deductions? Are you missing out on VIP passes because you don't realize your weekend side hustle qualifies as a legitimate business? The tax code is undeniably complex, but understanding this funnel is the absolute key to shrinking your taxable income. Keep learning, keep digging into the rules, and make absolutely sure your money is working for you, not just the IRS. Thanks for joining me on this explainer.